Hello and welcome. Good evening. You're watching Markets Tomorrow right here on ET Now. I am Ajay Sharma. Let's take a look at the top headlines of today. Last hour pullback helped the Nifty closed flat, but 10,000 sustains on the index. Big moves in the banking stocks, especially the private banking pack. However, pharma and metal came under some amount of profit taking in today's session. It was a mixed show from Maruti today. Higher costs dented the profits, while one-offs impacted GST, also some eating into some amount of margin. Top line come in line with the street expectations. And it was a total disappointment by Dr. Reddy's in the first quarter. Pricing concerns hurt the US sales this quarter. Margins take a huge knockdown. Stocks slumped over 3% in trade, weighing down the entire pharma pack in trade today. And it was a stable first quarter performance by HCL Tech. The stock nudged the 52-week high after the company maintains the FY18 revenue guidance. Management gives a fairly optimistic outlook for future, and that also helped the stock. They go on to say that deal pipeline in US and Europe, their big markets, continues to remain robust. That it was HDFC knocking at life highs today. Stock extended gains on heavy volumes, making it the top performer on Nifty today. Macquarie raised the target close to 1900 rupees a share, and it gained almost 100 rupees, 6% higher in today's session. But from the broader market, it was Indiabull Real Estate which almost gained 10% in trade, but gave up all the gains by the end. It was a 8-year high level which the stock actually touched. CLSA has initiated coverage with the outperform rating on it, saying that almost 50% upside exists in that particular stock over the next 2 years, and that's the potential, and that was the big intraday mover in today's session. Let's also invite our guests on the show. Joining us, Ajay Bagga, market veteran. Apart from that, Sacchitanand Uttekar also is here. He will help us in data analysis from the technical side. Gentlemen, good evening, both of you. Thank you so much. Before I come to you and start talking to you about markets, let's also get in a roundup of the July series. It was one of its kind series in a long time. Vivek joins us to round up the series and what all ingredients went into this kind of almost 6% move in Nifty futures this series. Vivek?
Well, if you're looking at the F&O series that just went by, it has been a historic series as far as Indian markets are concerned. The Nifty hit the coveted 5-digit mark, and if you're looking at the last day's up move of this particular series, Nifty actually scaled up a further 100 points and went and hit the 10,100 mark in trade today. So let us just analyze, what has actually led the last leg of the rally, and what has actually led such a strong up move as far as the Indian markets are concerned in this particular F&O series. First on your list, if you're looking at it, the implementation of the GST provided a big fillip to the Indian investors, and if another thing is that FIIs again started finding a lot of quality in the Indian names, given the fact that this historic tax reform was implemented. One of the main movers, in fact the second biggest mover on the Nifty as far as this series was concerned, was Reliance Industries. Well, a couple of key points as far as the company's earnings were concerned. Company put an end to the free tariff plan. This is something that the street cheered. And at the core refining business, if you're looking at it, the company came out with very strong gross refining margins, beating street estimates. Also, if you're looking at the private banks, especially Yes Bank, these companies came out with very strong numbers, and this cheer continued. So all of the private banks actually led a very good recovery as far as the market move was concerned this series. And last on my list, this is what has been leading the rally as far as the Nifty move from 9,000 to 10,000 is concerned. It's a domestic liquidity. Domestic mutual funds are flush with money, and investors continue to pour in money as far as lump sum as well as SIP investments are concerned.
Thanks very much for that, Vivek. In fact, that brings us to the question of the day we are chatting about with our guest. With this kind of a big rally under the belt, 6% in the July series, what does the market hold for us in the August series? Will this furious rally continue in the August series as well? Let's go to Mr. Bagga for the first reaction. Sir, you've seen market from the trading point, from the investment side. The way rally has been panning out series after series, adding 6% this one series alone, what is the probability would you assign for the pace of the rally continue in August series as well?
Yes, thank you, Ajay, for having me. I think couple of things working for the markets right now is the global macro, a very strong recovery in the global macro, central bank action getting discounted pretty soon. It's not having the impact that the market was fearing. The third big thing is the global liquidity and including the domestic liquidity in India. Those are the major factors. But as Howard Marks wrote in the memo which he published last night, we are reaching very frothy levels in global markets, and the correction in these markets will probably come from an external source, be it geopolitical, be it a US debt ceiling agreement not getting reached in September. Some trigger like that would really be the catalyst. Otherwise, there is enough money on the sidelines. I remain quite positive on the markets. 6% repetition will be difficult. So we are happy if you get a 1% series in August, and so you continue with the markets growing slowly and absorbing this kind of fast and furious growth. What helped this series, Ajay, also was the SEBI decision on P notes. So roughly about 25,000 crores out of the 40,000 crores P note derivative exposure would have got extinguished today with the July expiries, and probably that gave a lot of benefit to the market, because those shorts were taken out of the market artificially by regulatory action. So we'll have to see now in August what is the scenario, but overall we are confident. There could be a little bit of a correction, but there is so much money chasing stocks right now. And as I was mentioning Mr. Marks, he said in his memo, too much money, too little fear. I think that sums up the markets right now. There's just too much liquidity, and the risk aversion is at historic lows. The VIX in New York Stock Exchange, if you look at it, it's at 1993 low of when Bill Clinton got inaugurated in a very Goldilocks kind of an environment. That's the level to which the risk aversion has gone down to. So overall, this might continue for some more time, though the naysayers would like the market to come down. I think 1 or 2%, 3% fall, and then you will see fresh buying coming in, and it will stay a buy on dips market, at least for the next few quarters. That would be my best guess.
Fair point, Ajay. We'll probe you on more on that one, but let's talk about the point which you were just making with Sacchitanand as well. On technical, Sacchitanand, how does it look like? Ajay was making a very pertinent point, the way the short covering was also aiding the rally, and those shorts have extinguished now. So the cushion in the market is absent. Do you think fresh longs or rollover data, how did you analyze? How does the charts tell you of Bank Nifty and Nifty in the medium term?
Well, when we look at the overall trend, there are two perspectives which are there. One is how is the direction here, and how is the momentum. So if you look at the last series itself, we did see a decent correction in the market, and this particular expiry itself started on a very optimistic note, right from 9,500 till 10,000. We did not see any meaningful correction in the market. And if you look at even the data right now, though the rollovers have not been that robust, but there is a sense of some pessimism which is getting developed right now. We have already reached the level of around 10,000, and if you look at some of the momentum oscillators now, they have started tipping out. So basically, if you are talking about purely on momentum basis, a breach below 9,920, this will be a critical level so far as the momentum is concerned, and if we see the Nifty slipping below that, then definitely we may see a healthy correction in the market. But so far as the trend or the overall broader trend is concerned, I think it's a buy on declines kind of a market. The uptrend has been very much intact. It's a secular uptrend. So we are not really bearish on the market. We have we expected the levels around 10,013 to be reached in this particular expiry, and that particular target has been done. But I think going forward, we may see that the next push may just come because of the earnings, and in case if the earnings are not delivered, the markets may correct substantially towards the levels around 9,600 as well.
Right, talking of earnings, one stock really outshone many others on the street today was HDFC Limited on the back of good earnings and brokerage upgrades. Tanya is here to wrap the trade on HDFC today, which was the best performer in index in today's session. Tanya, fill us in.
Well, HDFC Limited was clearly the stock of the day. In fact, they got an upgrade from the Macquarie, which has been basically either neutral or negative on the stock by, or since almost 2012. So the brokerage has upgraded the stock to an outperform stance with a target price of almost 2,000, implying significant upside from the current levels. What is it that they like about the company? Well, the fact that the loan growth has been very strong, specifically driven by the commercial segment, and from here on they just see return ratios improving going forward. In fact, they also say that from quarter 2 onwards, HDFC Bank will be its dividend income will start showing on the books, which will get the effective tax rate down to 31% again for the company. On the back of that and the strong earnings, the stock has almost been over 5% higher in trade. It hit its lifetime high levels, and it has actually seen its largest up move since over a year, given the fact that never before has an earnings reaction been so strongly taken by HDFC Limited. So basically volumes at about 1.5 times the last 5-day average, and obviously the stock of the day.
Thanks very much for that, Tanya. Poonam, what about ICICI Bank? What are you watching out for there?
Well, in fact, ICICI Bank should be reporting a slightly muted operating performance, and hence we should be seeing the profits coming under pressure during this quarter, but there might be some amount of positive surprise in terms of the asset quality. Firstly, in terms of the profits, it's likely a 20-30 crore, a contraction of nearly around 9%. However, we should be seeing a slightly better NII growth of close to around 12% Having said that, the NII growth is still relatively muted because of the margins may possibly come under pressure because of the MCLR cuts. Not just that, loan growth also is likely to moderate to anywhere between 5 to 9% on a YOY basis. In terms of the other income also, on account of a higher base, the other income would be slightly lower, muted trading gains, and also a moderate fee income growth of just about 10%. But most importantly, in terms of the asset quality, we possibly may see the reversal or an upgrade of the JPA account. This cement account did turn into NPA in the last quarter, and hence we should be seeing some amount of reversals coming there in terms of the provisions. Not just that, there is again a possibility that we may see slightly lower slippages on a quarter-on-quarter basis, but still the slippages at an overall basis still may remain pretty much high. Management commentary in terms of the entire watch list would be important. Not just that, management commentary in terms of their exposure to the entire IBC accounts and how much provisions that they have made on this front would be very important. Besides it, of course, their commentary in terms of the overall loan book growth and any plans in terms of stake monetization in various ventures would be important. The stock is already up close to 7% since July itself, and it is also trading still attractively at 1.8x FY19 books. So any positive commentary would definitely possibly provide for the legs to the stock.
Right, thanks very much for that. Ajay, how would you look at this entire private financial space? And if one were to want to play it on the long side as a positional one, where would you find comfort? Large cap private banks with retail franchisee, or mortgage financiers like HDFC, or corporate banks? Where would you find more comfort on declines?
Well, valuations in all are very frothy. So, comfort in a valuation sense is difficult, but it's more momentum and growth that you have to play in this market. I think there the private sector retail focused banks will continue to do very well. We have seen that in the results so far, and in fact the bank nifty rise of 7.5% in this series was largely driven by that. So I would stick with that. The second preference would be for housing finance companies. There we are seeing a little bit of a slowdown, but again there is so much housing momentum in the economy, and the NPAs are sub 1% with fairly good margins. So and multi-year growth is forecast there. So housing finance companies would be second, and third would be the turnaround cases of private sector corporate focused banks. What has gone out of favor a bit is the smaller PSU banks, where there was some informed buying happening on the expectation of mergers. That seems to be holding up for now. And second is the older private sector banks. We have seen very strong rallies in them, but a few poor results and slippages have meant that they're going a bit out of favor, and there's a rotation back into the market leaders. So I would say stick with the market leaders, with the retail focused ones. That seems to be the better momentum and growth factor for now. Valuation wise, all are very highly valued, so value wise it's very difficult to really go and find value in this market.
Gentlemen, stay with us. That's the big dilemma right now, for sure, valuation argument. But we'll talk about earnings. That's the focus right now, in the middle of it. L&T earning will be on spotlight when we return from this very short break. Welcome back. Still watching Markets Tomorrow right here on ET Now. L&T is one stock is in focus right now. There's a lot of promise in the first quarter numbers. Analysts in the street is expecting good performance, but academically, what exactly are the factors to watch out for? Awan is here joining us on the show to tell exactly that about Larsen & Toubro this quarter. Awan?
Well, all eyes on L&T, and we're expecting a profit growth of about 7% to 23,490 crore rupees, and this will largely be driven by the heavy engineering and the hydrocarbon segment, which has seen large overseas orders recently. The profit growth is likely to come in higher by 52% at 925 crores, and operationally it's expected to be steady, with EBITDA growing about 15% to 2,196 crores and margins seen at 9.3%. The lower cost of the working capital loans, as well as the high tax rate and the normalization of the tax rate, given the fact that last year had an abnormally high tax incidence of almost 39%, is what is going to drive the profits. Margins will not really see a material change this time around. The segmental performance, good growth print expected in the heavy engineering segment as well as hydrocarbon, which is what is going to propel the growth. Weakness could be witnessed in the infrastructure and the E&A segments, and the core infrastructure segment could grow at just about 10%, which will be supported by a strong order book. IT and finance is seen growing about 8%. Remember, they've announced an order intake of about 12,900 crores in the first quarter. It's been supported by large orders as well as base order finalization, and domestic order wins as well have been strong in the hydrocarbon segment. Overseas order finalization was supported by the water as well as the power and T&D segment. And remember, they had raised the revenue as well as the order guidance for FY18 to 12% and the order guidance to about 12 to 14%. So we'll have to wait and watch the management commentary on these two parameters. The sustainability of the net working capital as well will be a key monitorable.
Thanks for that, Awan. Sacchitanand, how are you looking at Larsen's charts? We've seen a lot of open interest position also built up. People were quite positive on it going into results, but what is your take on Larsen as a trade?
Well, if you look at a broader perspective, I think 1220, 1250 has been a very strong resistance for the stock. But if you look at last 3 months itself, last 3 expiries itself, the stock has consolidated well within a very narrow band of 1100 and 1180. So I think this is a very good positive sign. In case if we see the level of around 1220 getting breached in this particular expiry, we may see an extension of this particular up move right up to 1400, 1410, and this could be one of the outperformers in the coming months. But I think 1220 would be the key trigger level, and one has to watch out how this particular level is getting breached on the upside. So overall, the overall stance as of now is more or less on the range bound side. But if you look at the monthly formation, then it looks like that this particular range may be breached this time.
Right. Ajay, what are your thoughts? So what do you like in this market right now? You did indicate that though momentum and liquidity is fueling this rally, but valuations perhaps have started to look frothy. So with your vast experience, how should one be approaching this market right now? What's the prudent strategy, and what are the specific areas you're looking at?
Yeah, I think it will be very prudent to take profits. If you are in profits, take some money off. But again, I'm reasserting there is nothing to worry in the shorter period. We don't see a very deep correction or a very wide correction happening because there is so much money sitting on the sidelines, which is chasing risk assets. Even you've reached a level where the Fed comes out and says that they would start tapering in a sense, and look at the difference between Ben Bernanke's statement in May 2013 and now. That caused havoc in the emerging markets, and yesterday it was just digested that okay, September 19th, 20th probably Fed will announce the first reduction in its balance sheet in 10 years, and there was no in fact the US markets ended at record closes and Asia took over from them. So that is pointing to the fact that too much money, too little fear. That story normally doesn't end well, but it takes multiple years. In 1996 is when Greenspan spoke about irrational exuberance, and it took us till 2000 early 2001 that the dot-com crash finally happened. So if you took Greenspan on his word, 4 years you wouldn't have made money, as Warren Buffett did not, as Julian Robertson did not. All the value investors got really badly whipsawed at that time. So again, I'm saying this is a market you have to play for growth. You have to go with the momentum. You can't be on the sidelines, and you have to invest for growth. Where is the growth? Growth is in the private sector banks, growth is in the housing finance, it's in the automobile companies. It will return to the two-wheeler companies 6 months to 9 months down the line, so might be a good time to start looking at them. Durable companies, anything to do with domestic consumption, auto ancillary, tire companies, anything that's feeding into the India growth story, and which is not really linked into a global slowdown which might come next year sometime. I think those are a few of the key factors that can be looked at. So despite sounding cautious, I'm not out of the market. I would still put in more money, but put in a very calibrated manner. Don't put all your eggs together. Take some time to invest.
Fair point, Ajay. Sacchitanand, what about you? What are your top picks right now?
Well, we have two stock ideas for the coming weeks. In fact, one on the long side and one on the short side. So taking the short call first, we have already seen HCL coming out with its earnings, and if you look at the movement of the stock for the last 6 months, it had been oscillating within an upward rising channel, and the upper end of the channel is placed somewhere close to 910. We have already seen this particular level being reached. The oscillators are not so comforting. We expect this particular channel to play out well, and we expect a cool off kind of a situation here. We expect the stock to again come back to 860 levels. So a stop loss can be placed at around 924, and short positions can be considered somewhere close to 910. The second call is a long call on IGL. This particular stock has been in a very secular uptrend. We have already seen a good consolidation and a breakout getting placed today. The breakout has been accompanied with good volumes, and we expect this particular breakout, the momentum to continue further towards 1240 levels. So from a positional perspective, a stop loss can be placed around 1150, and a trade of around 1240 is something that we are looking at.
Right. All right, Sacchitanand, thanks very much for that. In fact, gentlemen, both of you, thank you so much for taking out time for us and joining us on the show. With that, it's a wrap on Markets Tomorrow. Thanks very much for watching the show.